This video is designed to help Year 12 accounting students know and understand how to record and report inventory write-down. This goes with the video that talks about net realisable value, so these should be watched together. So inventory write-down is an expense that is incurred when the NRV or net realisable value of an item falls below its cost price or its original purchase price. The process of writing down inventory ensures faithful representation. So in the previous video we talked about the idea of verifiability and how cost price or original purchase price provides this. But it's important that when we're calculating our inventory write-down, we remember that faithful representation is about the accuracy of our records. And so if we can no longer get the original purchase price for our item, we should change our records and our reports to ensure that the information is accurate. So some examples of when you might do an inventory write-down might be if you're doing some kind of clearance of old items. So remember from video 1, there are reasons why we might need to change the value of inventory to its NRV. So examples might be something like a car yard, like Toyota here, might decide to slash the prices of old vehicles because they've got new vehicles coming into stock. Another option might be something like this, which is from Harris Scarfe, and that was due to the fact that they were running out of cash, and so they needed to sell a lot of their items to make sure that they could stay alive as a business. Some businesses might also do that big sales for things like end of financial year, in the case of Vistaprint there. So calculating inventory write-down. Before you can calculate an inventory write-down, you need to find out which is lower, cost price or net realisable value. So from video 1, we looked at an example where there was a new model of television coming into the business, Terry's TVs, and we determined that the NRV was $1,150 compared to the original purchase price or the cost price of $1,200. So in order to calculate the expense of inventory write-down, we need to take the total cost price and we need to minus the total NRV. So in this case here, the cost price was $1,200 minus $1,150. So the write-down needs to be $50. Now that is per TV. And in this case, we have got 8 TVs. So we need to write each of those down $50. That's going to lead to a $400 inventory write-down. So it's important to remember to not only calculate it for one item, but to make sure you're checking how many items out of my inventory do I have to write down. And your write-down should be recorded as a total for that inventory item. So let's have a look at what happens in the records. So we've got here our inventory card and we've got our general journal. So if I go back a little bit, I've got memo 24. And this occurs on the 31st of May. So May 31, memo 24. And what I'm going to do here is I'm going to put 8 in my quantity because I'm writing down 8 of these items. Each item is going to be written down $50 and the total is going to be $400 here. And the total is going to be $400 here. So what's going to happen in my balance is I'm still going to have 8 of these televisions, but instead of having a cost of $1,200, they're now going to have a cost of $1,150. So the total is now going to be $9,200. I'm taking that $400 off the total balance. What does this look like in the general journal? Well, on May 31, I've got the creation of an expense called inventory write-down. And with an expense increasing, that's going to be debited $400. Inventory, the balance of inventory is now an asset that is decreasing, so it's going to be credited. And my narration here, same as when I'm dealing with all other inventories, I'm going to say what's occurring, which inventory item, and how many. So it's important to include the type of inventory and the quantity. So I'm going to have here inventory write-down of 8 Samsung 65-inch TV. And if they provide you a reason, you should include that, similar to things like a sales return. So I'm just going to put in here new model released. And don't forget to include your memo, so memo 24. So this is what it's going to look like in our records for our inventory card and also for our general journal. Jumping over into our general ledger, what we're going to see is another addition to our inventory account. So you can see that our inventory account's getting quite busy and quite popular in terms of the kinds of transactions that affect it. So applying my information from my general journal here, I would have something like this, where on May 31, in the inventory write-down account, there would be a $400 debit, and that would be debited to the inventory account. In the inventory account on May 31, I would have a $400 credit, and that's going to be going to the inventory write-down account. So you can see we've got a new addition to our general ledger here as well. So this is in our records. In our reports, the expense of inventory write-down is going to be recorded in our income statement, just the same as any other revenue or expense. But because it's related to inventory, it's going to be recorded or reported in the trading section. So remember, the trading section of our income statement is from the top of the income statement up to this part here, adjusted gross profit. And the reason why we call it the trading section is because this is all to do with the selling of stock or inventory and related expenses. So we put inventory write-down in between gross profit and adjusted gross profit. This is where we also put our inventory loss and gain. So we are showing the effect of having to use the NRV instead of the cost price in between that gross profit, and then making those adjustments there. So one to be really careful of, this is a new addition into our income statement, so be sure that you don't forget to look for inventory write-down and include it into your reports from now on.